Hey, good afternoon or good morning, potentially on where you're listening to us from today. I want to welcome everyone to today's webinar where we're going to focus on just a different segment of the real estate investment opportunities that are out there. We have a guest speaker who we're going to have on join us here in a few minutes to talk about senior housing. It's a growing industry, obviously a growing investment opportunity. So we wanted to share some of that information with you today. Hopefully you can take it and apply it with your investment strategies as you move along. My name is Scott Maurer. I'll be your host, and I'll present a few minutes here at the beginning before turning things over to our guest. A little bit on my background. I've been with Advanta IRA for getting close to 15 years now, and I work primarily in the business development department of our business, helping to grow the business, helping to educate more and more people about self-directed IRAs and the ability to use your retirement funds to invest in a lot of different assets that we'll talk about here today as well. I'm also a licensed attorney by degree. I don't practice any legal work for any of Advanta clients. And my contact information is here on this screen. So if you have any questions on what I'm covering today or something to do with the self-directed IRA, please give me a call, shoot me an email. I'm more than happy to take some time and go over your questions, get those answered for you, potentially get you the right resources to help you make some decisions on your own as well. A quick disclaimer, Advanta IRA does not provide any legal, tax, or investment advice, and we do not endorse any particular products. Our materials are really only for educational purposes only. So all the webinars that we host, the events that we host, it's there to educate, it's there to inform, maybe open your eyes to different investment possibilities, but you are encouraged to do your due diligence on any investment you're looking to make, anybody that you're looking to invest with, even if it's somebody we featured on one of the webinars. It is up to you to perform that aspect of the investment process. We can certainly refer you to attorneys or CPAs or financial advisors as well for additional guidance before you're going to enter into any type of investment. Just a quick background on Advanta IRA. We've been around for almost 20 years. We have over $1.3 billion in assets that we hold. We have two offices. Our main office is based in the Tampa Bay area. We have another office in Atlanta. But we do work with clients all over the country and really specialize in offering kind of that dedicated customer service experience. We appoint every new account with one person in our office who will be that client's contact for anything that they need regarding their self-directed IRA account, something we instituted a few years ago for both clients and referral sources, and have found that it's been very successful in making things run very easily and more smoothly for all of our clients. We also focus a lot on the education. Today's event is just yet another example of bringing in, again, a guest speaker, someone who's knowledgeable in a specific area of real estate investing or just investing in general. Prior to COVID, we were doing live seminars in our office. We certainly hope to get those started at some point again. We will do that once it is safe to do so. But for right now, we're offering a lot of webinars online, usually one or two a week. And also networking events. We have a networking event that we host every other Friday that we call Pitch, Promote, and Prosper. It's an opportunity for individuals who are looking to invest or people who are looking to sell an investment or have investment opportunities. It's an online kind of networking forum. Again, we host this every other Friday. The next one coming up will be September 25th. It's free to join. You just need to sign up, and we usually give everybody an opportunity during that time to go around and introduce yourself, what you're looking to invest in, if you have a particular investment you're looking to sell. Again, it's a great chance, kind of, let's say, first in the industry necessarily, but an opportunity really to get people that kind of matching that we are unable to do at Advanta. We cannot put people together ourselves, but instead we decided to present this forum where like-minded individuals could come together and share investment ideas. So you can certainly register that for those events coming up on our website as well. So before we bring in our guest speaker here in a minute, I want to talk a little bit about some basics on self-directed IRAs. Now, for anyone who's listening live to the presentation today, if you have questions for myself, or if you have questions for our guest presenter, please type those into the question box on your screen. There's also a handout that you can download. If you want a copy of the slides, you can download that handout right on your GoToWebinar dashboard and actually pull those down. You can certainly email me afterwards for them, but it's easy to get it right now through that. If you are someone who's listening to the recorded version, certainly reach out to me and I'll get you the information that you need. But again, live attendees today, please ask questions as we go along. So very quickly, what a self-directed IRA is, it's just a special type of retirement plan where an individual, the IRA owner, gets to decide what type of asset class they want to invest in, as opposed to being limited to those investments that are sold or promoted by their particular broker. So a lot of individuals who have 401ks or who have IRAs hold those account in a brokerage firm or with a bank where they're only offering you investments in things, particular assets that they sell and profit upon. That is their business model. But IRS regulations allow you to invest in a large variety of assets outside of the stock market or outside of what a bank might offer you. So since these assets are not publicly traded, potentially the market fluctuations, at least the stock market fluctuations, hopefully won't impact your returns as much. So people are looking at self-directed IRAs as a way to diversify their accounts and put their investments into things that they know and that they can control. As far as if anyone's listening as well today, I think a lot of times the webinars we have a lot of people who attend because they're looking how to deploy their own capital into an investment. We also have a number of attendees maybe who are looking to raise capital. So even though you may be looking at this for how to invest my own IRA, at some point you might have an investment where you're looking to raise capital. And so I want to hit on just a few reasons why I think self-directed IRAs are a good capital source. For one, you get a repeat investor. If you're already working with a group of investors, you have a bank of contacts to tap into, showing those individuals how they can use their IRA accounts to invest can unlock more money for you. Those people that you're already dealing with may not realize they can use their IRA to make this type of an investment. Also, you hopefully offer better returns in either the stock market or maybe what's going on in a bank CD account. There's no outside approval needed. If an individual wants to use their IRA to invest with you or into your project, it is simply the IRA owner making that decision to make the investment. There is no other additional approval process or loan review process that you'd have to go through with that IRA owner. And I think one of the biggest reasons, especially for longer and some longer term investments, is that most people are not expecting to use their IRA money soon. So they have their IRA, they have their 401k. That's an account that they have set up. They plan on tapping to that in their retirement years, which may be 10, 15, 25, 25 plus years away. If you have an investment that they can make, and it might be a 3 to 5 year hold, they don't mind making that investment with their IRA since they weren't planning on touching that money anyway. Now, people's individual savings accounts or their rainy day fund, they're less likely to lock that money up in an illiquid investment. So again, I think when we talk about real estate and longer term investments, that's one of the reasons why IRAs are so attractive for people who are looking to invest. Now, a self-directed IRA, the self-directed refers only to the ability for you to make alternative investments inside your plan. It is not a certain type of IRA necessarily that the IRS specifies. The IRS designates IRA accounts as either traditional or Roth IRAs, SEP, or simple IRAs. So the accounts at Advanta we still have traditional Roth, SEP, or simple IRAs. We just call them self-directed because with our plan, again, you can choose the type of investment that you wish to make inside the retirement account. In addition to the traditional Roth, SEPs, and simples that we have at Advanta, we also can hold solo 401k plans, education accounts, and health accounts. And then also the big bucket, I think, that gets missed a lot when individuals are thinking about investments that they want to make or where can I pull this money from for my investment, are those former employer plans. When somebody leaves their job, they leave their prior employer and they have a 401k or a 403b or a 457 plan, and they leave that behind, they kind of forget about it and they're transitioning to a new job. But those old employer plans can also be rolled over and put into an IRA account and certainly self-directed. The only restriction on retirement accounts is for self-directing a lot of times is your current employer plans. Your current employer can restrict your ability to move some of that money if you're still employed with them. But any IRA, any old employer plan certainly qualifies to be self-directed. And getting that money moved over into a self-directed account is just a matter of filling out the right paperwork. It's either doing a transfer. If you're moving from IRA to IRA, it's considered a trustee to trustee transfer. Or if you're moving money from that old employer plan, that old 401k, to an IRA, it's just considered a direct rollover. Both transfers and direct rollovers are non-taxable events. So moving money from an account at Vanguard or at Fidelity to Advanta, there's no tax consequence to doing so. And you can move that money as often and whenever you'd like between your IRA accounts. There is no restriction on doing so. It just takes paperwork each time to get that money moved over. And that's just something that we walk you through at the outset of getting your account set up, identifying where your funds are currently held, and then instructing you on the best way to get that money moved over. Over the years, again, having been with the company almost 15 years, people ask, why do people choose to self-direct? In talking with people over these years, I think most people fit into one or more of the buckets on this screen. For some clients, in using a self-directed IRA is simply that they're using a different source of capital to make investments that they're already familiar with. So if someone who's already investing in, say, rental properties, or they're investing in ALFs or senior housing facilities, they might already be doing that on an individual basis. Using their IRA just provides them with another source of capital to make an additional investment. So it's money that they didn't know that they could use for that particular alternative asset. For some clients, it's the tax benefits, being able to invest in alternative assets and have the rents, the dividends, the profits from that investment accrue back to their IRA tax deferred or tax free, depending on the type of an account. Certainly is attractive for a number of individuals, especially people who are in a high income tax bracket now. They don't want the income from investments bumping them up even higher. They'd rather make those investments inside of the IRA account and have that money be accruing tax deferred or tax free. And then certainly there's a large number of clients who it's the stock market fatigue, the ups and downs of the market. I saw an infographic a little earlier today, just with the stock market, the blips up and down the last few weeks, just seeing them go up and down every other day almost. And some people just get tired of that and they look for alternatives to put their money, at least some of their money into, that they know that they can control and not have to worry about what happens in the stock market on a day-to-day basis. So kind of leading in, we're going to bring on our guest speaker here in just a minute. But a lot of what we talk about, a lot of the webinars that we do here at Advanta are focused on real estate. It's probably makes up the vast majority of the assets that our clients invest in, whether it's single family homes, people buying, for long-term rental, maybe they're looking for a flip project, people investing in condos, mobile homes, tax deeds. Those are some of the more active investments where an individual does have to be a little bit more involved. If you're going to buy a rental property, even though you can't do the work on the property, you need to be probably talking to your contractors. If you're going to lease the property out, you're helping to find your tenants, and you're being a little bit more involved and more active in that type of an investment. But then we also have a couple other, you have people who prefer maybe to be a little more passive, and that's what our guest speaker is going to come on today, is one of those segments of passive investments where your IRA can invest in a larger project, and you actually give up some of the control of the investment, simply put your IRA into that structure, let someone else manage it, and you sit back and get your return each month back to that account. That can be, again, as we're going to talk about today, the senior housing, assisted living facility type investments, people doing private REITs, private placements and syndications that we see a lot with commercial and multifamily a lot. So as long as you're not using your IRA to buy a vacation home or some property that you want to live in, there's a lot of different things you can do, obviously, in the real estate realm. And that's why today we're going to bring on our speaker, Matt Johnson with the McFarlin Group. Matt has 2 decades of experience creating value in senior living investments and acquiring and building a lot of different investments. Matt, are you there?
Thank you, Scott. I appreciate it, and wanted to confirm you can see my screen.
I can. You can see the screen just fine. Again, anyone who's listening live today, if you have questions as we go along, please get those asked to me. I'm going to let Matt do a little more intro. I was starting to read a little bit more and I got interrupted. I had something happen with my computer. But so Matt, I want to make sure that you introduce yourself. And again, anyone who's listening live today, if you have questions, type those in the question box on your screen. We'll make sure we get those answered. But Matt, at this point, I'm going to turn the presentation over to you, and I'll just monitor the questions.
Great. Thank you, Scott. I appreciate it. Thank you, everyone, for your attendance. Today, I'd like to cover in just about 15 or 20 minutes a brief overview of McFarlin Group, but then really talk about the state of senior housing. What was the state of senior housing pre-COVID, and what impact has the current pandemic and COVID-19 had on the senior housing community, focusing on ownership from the investor or investment perspective, and then talk about very briefly our response to what we're seeing occur in the industry pre-COVID and post-COVID. And then we'll have a brief Q&A period. So McFarlin Group is, we're a vertically integrated senior living firm, which means we are a developer, owner, operator, and investor in senior living properties. Since 2001, our principals have approximately $2 billion in senior living experience. The 3 investment committee members at McFarlin Group have a combined 56 years of experience in senior living. We have around 13 corporate employees. Because we operate senior living communities as well through a related company called Surpass Senior Living, we have around 375 employees in Surpass Senior Living entity. Our historical IRR for our investors has been a 28% IRR, and we focus on senior living. We don't cover other real estate asset classes other than senior living and healthcare, with a significant focus on senior living. To date, since McFarlin was founded in 2008, we've raised a little over 100 million in total equity for around 325 million in total project costs, with an estimated value for all of our communities and transactions around 550 million. As I mentioned, our investors to date have realized a 28% IRR and about a 2.25 multiple on cash investment. And we do have a lot of investors that invest with us through their IRAs, which, as Scott presented, provides all of those tax benefits for investors. So the key themes in senior housing, and I'm going to break this up into pre-COVID and post-COVID. And pre-COVID, there was evidence of distress in senior living, primarily due to an overbuilding that occurred. Assisted living occupancy reached its lowest levels at 85.1% occupancy nationwide in the end of third quarter 2019. Again, that's the lowest level since 2005, when we started recording occupancy level at assisted living, which includes memory care or all Alzheimer's properties. So since 2005, when our industry started recording occupancy information. Q4, it ticked up slightly to 84.5% occupancy. So absorption outpaced new supply for the first time in 3 years as of the third quarter 2019. So generally, this theme pre-COVID was that there was an overbuilding in senior living at a national level, but senior housing is definitely a local business, and occupancies vary market to market. Seattle, San Jose, Minneapolis, Boston are relatively insulated markets due to higher barriers to entry, whether it's availability of land, regulatory environment, or other things, make it a more difficult place to develop new senior living properties, and therefore those markets have higher occupancy levels. Assisted living construction starts were trending lower in 2019, which is why in Q4 we saw absorption outpace demand or outpace new supply for the first time in many years. And then same store asking rents have decelerated because of the oversupply. We're not increasing rents as high as we were previously from prior years. So it's been declining through 2019 as well, and got to its lowest level as well in Q3 2019 at 2.3% year-over-year increase in asking rents. Post-COVID, we saw stabilized occupancy levels decline starting in March 2020, and April and July were the worst reporting periods, or the largest drop in stabilized occupancies, and we'll get into that a little bit. And then, as I mentioned earlier, there's a wide range of occupancy rates across the nation. San Jose has some of the strongest occupancies at 88% in that market area, which is down from about 95% pre-COVID. And then San Antonio averaging 75% occupancy, again, down around 8 percentage points from pre-COVID levels.
Hey, Matt, I have a quick question for you, if you don't mind. I had somebody, and this goes back to one of the slides or two you had before, just somebody was asking about the 28% IRR. Has that been for new ground-up development projects typically? Or I guess that's kind of asking, or and how many investments in existing facilities have been made, distressed or otherwise? If you can maybe speak a little bit on that quickly before we get back to the presentation on and what you guys focus there at McFarlin.
Sure, absolutely. So that includes development and acquisition and distressed property acquisitions, but it has been historically on our realized transactions has been weighted more heavily towards development, as from 2008 up until 2017, 2018, we were primarily focused on development. So a lot of these returns and yields have been development focused, correct. We started acquiring properties in 2018 and 2019, and we have had some sales of properties, and the IRRs are generally in line or strong. Sorry, the cash multiple is generally in line, but what we're finding is that the IRRs are much higher because we're able to buy a property and not have to wait through the long construction period and then lease up. We're buying a property that's already constructed. It has some occupancy challenges, and we're able to turn around the investment at a faster time period. Therefore, the IRRs that we've seen more of late have been a little bit higher. And
Okay, good.
I'm happy to share, when I get to the end of the presentation, I'll share my contact information, and happy to share our detailed track record by project since the founding of the company in 2008.
Okay, yeah, again, anyone that has listening live, you have questions like that as we go along, please get those typed in the chat box and we'll make sure to get those questions to Matt. So Matt, continue on.
Great, so the construction boom, as you can see from this chart, really started in around 2012 to 2013. As we exited the Great Recession, we saw development increase or supply increase really at colossal levels. Builders of assisted living overestimated the current demand and timing of that demand for assisted living properties. The oldest baby boomer turned 74 years old on January 1st this year, and they're still 8 to 9 years away from assisted living, as our typical assisted living resident is generally between 82 to 86 years old. So there was significant emphasis on the 65 and older population from developers, and we saw a lot of developers migrate into the assisted living space from other areas. We saw multifamily developers migrate into assisted living development because of the yields have compressed in multifamily, and they saw senior living as a extension of their development, and they saw the yields very attractive for themselves and their investors. We saw similar theme from hospitality developers building hotels, migrating into senior living, and then healthcare developers building medical office buildings. With the changes in Stark regulations and physician investment in senior living or in healthcare facilities, we saw a lot of medical office builders run into assisted living as an extension of their development capabilities. And again, those groups focusing heavily on the 65 and older population, which is driven by the baby boomers. And the baby boomers were born between 1946 and 64. So the oldest boomer is 74 and the youngest boomer is 56. Again, our average resident profile is 82 to 86 years old. So the baby boomers have yet to provide any significant impact on assisted living and Alzheimer's occupancies. However, Alzheimer's disease doesn't discriminate based on age, and we do certainly see residents in senior living facilities, particularly in our dementia or Alzheimer's areas that are 65 years of age and younger. But generally, construction as a percentage of inventory shown by the orange line presents that we were building as a industry at around 8 to 10% of total supply for a number of years. So about 40 to 45% of the total supply of senior living properties on the market today were built within the last 8 years. So a considerable amount of supply added in a short amount of time. So the impact that that has had on occupancies is shown in this chart, and it's very correlated to the increase in construction, as you'll see a decline in occupancy levels. The blue line at the top is independent living occupancies, generally serving a younger senior, 74 to 82 years old. And those occupancies have been certainly stronger than assisted living and memory care, which is represented by the orange line. And again, that orange line includes both assisted living and memory care. And then the gray line represents all seniors housing, so independent, assisted, and memory care. It's essentially the average of the blue and orange lines. So as you can see, as the development increased, 2012, 2013, and then those properties were delivered for occupancy in late 2013, early 2014, is when we started to see the decline in occupancies for assisted living and memory care, represented by the orange line. And they continued to decline until, as I mentioned, third quarter 2019, where occupancy for assisted living and memory care reached its lowest levels ever at 85.1%, and had a slight increase to 85.4% in 2019, or Q4 2019, as absorption or occupancy outpaced supply growth for the first time in many years.
Hey, Matt, I have a quick question, kind of looking at the graph too, just going even back farther to 2008, 2009, we see that kind of the huge drop. Was that due to the recession back then and people, I guess, choosing to maybe keep their parents or their grandparents over living with them as opposed to putting them in to those types of facilities? Is that what the attribute that drop back in 08, 09?
It certainly was, and that was more of a financial driven recession rather than the current pandemic, which we'll talk about in a moment, or the overbuilding that occurred. So you're absolutely right. As you can see, those occupancies decline. It was a much shorter or compressed occupancy decline as a result of the events from 2007 to 2009, and again, those primarily being disruptions in the financial markets and perceived loss of income, seniors not being able to sell their homes during that time period and therefore not moving to assisted living, but choosing to stay in their homes because they couldn't sell their homes. And then, Scott, as you see, we have this long ramp up in occupancy again. And our crystal ball is very similar, that we believe there'll be this long ramp up in occupancy again over the next 3 to 5 years from this decline caused by an overbuilding and also by COVID-19. So as you can see, this chart tracks occupancy over a 12-month period. Again, the green is independent living, and we're going to really focus on the blue, which is assisted living and Alzheimer's care properties. And as you can see from the top graph, those are representative of occupancy levels nationwide. And then the bottom chart is a decrease in occupancy month over month. So as you can see, the pandemic really started in March, and we saw the largest decline in occupancy occur in April. Assisted living and memory care, represented by the blue line, just under a 2% drop in occupancy in April alone, declining a little bit in May, again in June, and then another increase, more substantial increase in July. Again, the reason for the declines over this time period is the impact of COVID-19 and seniors deciding not to move into senior living, families choosing to keep mom or dad at home because they are either out of work or they are working from home. And so COVID-19 has deepened the distress in senior living. From our perspective, it's really not the root cause of some of the distress from an investor's perspective in senior living. That was really caused by overbuilding. But now the impact of COVID-19 and declining occupancies has deepened that distress. Occupancy declining primarily as a result of limiting visitation from new prospects due to the sheltering of the most vulnerable population, our seniors and elderly. And then rent concessions are offered to gain occupancy, which reduce the revenue per unit that senior living operators are seeing currently. So that dual effect of declining occupancy and senior living providers offering rent concessions to sustain or try and grow occupancy census is really compressing revenues. And then the restrictions that the states have in place for senior living limits the showings of potential new residents and really has created difficulties coordinating the move-in process. So most senior living providers, including ourselves, have gone to virtual tours where we are presenting the community units and trying to create a sense of what life is like in senior living all through video, as opposed to being able to present it in person, because most senior living providers have not been allowed by states and governing authorities to do tours of residents. In addition, it would probably be perceived as hypocritical if we were not allowing families to visit seniors, but we were allowing new prospects to come visit. And so families, for those reasons of not being able to visit their mom or dad if they move into senior living, have decided to keep their loved ones at home until the virus is contained or a vaccine in place. And that has been the primary driver of declining occupancies, is that families are choosing to keep their loved ones at home. And then the dual effect of increased PPE supplies, hero pay or wage increases for our staff are increasing the expense burden at communities. So now we have this dual effect of declining occupancy and compressing revenues, and increasing expenses have led to EBITDA or net operating income compressing, and that has been leading to non-payment of mortgages in senior living. In addition, there's limited buyers in the short term of assisted living or memory care properties because asset level due diligence is restricted. Due to the quarantine and visitation restrictions, third parties, including owners, prospective owners or buyers, appraisal firms, property condition assessment, and phase one firms are not able to do full due diligence on senior living properties. So that's also affecting values in the short term, or affecting a provider's ability to sell a property quickly. And so private equity, public and private REITs and other traditional buyers are not really currently buying stabilized senior living assets. We're seeing that a lot of people are sitting on the sideline working to manage their existing portfolios and figure out how to maximize occupancy in their portfolios. I expect those buyers to come back in 2021 and certainly after the pandemic has ended. And then lastly, because senior living is an operating business, we found that because of the distress in senior living and non-payment of mortgages because of declines in cash flow and EBITDA, banks aren't being paid current, but banks are very hesitant to foreclose on senior living assets because they're afraid of the liability that comes along with ownership. They're afraid of owning an operating business, as they don't want to have to fund salaries, food costs, insurance, and other items within a senior living community. So we're finding that banks are selling loans at a considerable discount, anywhere from 10% to 50% of the par value of the mortgage, which is where McFarlin Group is currently focusing on, which I'll talk to at the end.
Yeah, Matt, and somebody had a question, it popped up. It said, was the occupancy drop in April due to deaths from COVID-19? If I'm hearing you correctly, that probably had some minimal impact, but it's more so almost like a disruption in simply the disruption in the business. You couldn't show people new product, new place to bring their loved ones, and certainly people were hesitant to even bring their loved ones to that type of facility due to what was going on in COVID. Did I sum up that correctly?
Correct. You're absolutely right. What we found is is because families were working from home or potentially unemployed, they were moving their mom or dad out of senior living facilities because they were concerned that they could develop COVID there. In addition, they felt like if they couldn't see their mom or dad and visit them in the community, that they would pull them out and move them back home because they were able to care for them at home during that time period and see their mom or dad. So that's the primary driver. There was a lot of press in March, April, and May about the considerable deaths in senior living, but that was really concentrated in skilled nursing. As skilled nursing is a much different resident profile than assisted living. There's a lot more employees and medical professionals entering those properties, those skilled nursing facilities, to care for the advanced care needs of those residents, and therefore they were more susceptible to contracting the virus just due to the number of ingoing and outgoing people to serve them. In addition, I think what we learned is that states were forcing skilled nursing facilities to take on COVID patients, and that's kind of the dirty laundry that wasn't presented or published or discussed until much later, is that states and healthcare institutions trying to keep beds and availability open were forcing skilled nursing facilities to take COVID positive residents, and they weren't really, frankly, prepared for that yet. They didn't have appropriate PPE supplies on hand, and so that's why I believe we saw the massive amounts of COVID at some of these skilled nursing facilities, due to the combination effect of being forced to take COVID positive residents, not having enough PPE supplies, and due to the higher acuity nature of those residents, a lot more staff and medical professionals in and out of properties providing services. Another effect, Scott, and why we see the decline in move outs in May and June, is that over this period of time, as families are caring for their mom or dad or their loved one, rather than moving them into an assisted living facility or taking them out and caring for them, what we really found is that the mother-daughter relationship changes from patient and caregiver. There's a loss of dignity and a intimacy barrier that gets broken, as an adult child, a daughter, is now the caregiver, providing incontinence needs, changing their mom or dad, providing eating assistance and ambulating assistance, and the incontinence needs that goes along with that. So it can be an embarrassment, or it can be a little bit degrading or loss of dignity, as I mentioned, for the senior, and it really changes that relationship, which is why I believe over the course of the next few months, we will continue to see the move out numbers decline, and we'll start to see some increases in occupancies as families start to go back to work. Even working from home, they'll be forced to work more, be a little bit more productive now. As well, the caregiver that is caring for mom or dad is now becoming tired and exhausted over the last 60, 90, 120 days. And given the advanced age of the residents, there's a decline in functionality, and a increase in the amount of services and care needs that senior may need over this 3, 4, and 5 month period, where it gets to the point where the family caregiver can't care for that loved one anymore at home, and they're physically exhausted, and they're looking to have their mom back and not be the caregiver any longer. So I think the longer the pandemic goes, we're starting to see that effect take place, and we're seeing fewer and fewer people choose to move their loved ones out of senior living. And now that senior living communities have appropriate PPE, and there is better statistics on how assisted living has been able to protect and care for residents and not spread COVID-19 within the walls of assisted living, I think that will produce, and is already starting to produce, greater lead inquiry volume at the top of the funnel in terms of new leads, and will ultimately drive occupancy as well. So what we're seeing is a temporary disruption in senior living caused by overbuilding and now deepened by the pandemic. However, the demographic tailwinds are extremely favorable. As you've all may have heard, the baby boom population being referred to as the graying of America or the senior tsunami, principally driven by the aging baby boomer population. So the growth in senior living is pretty dramatic over the next 30 to 40 years. And in fact, in 2034, we have a turning point in America where the first time ever in 2034, we are estimated to have more people over the age of 65 than we do under the age of 18. And that's expected to occur in 2034. So the powerful demographic tailwinds driven by the baby boomer will ultimately correct the overbuilding challenge that's occurred within senior living. This graph is an interesting analysis that we did that provided an estimate of the amount of inventory that will be needed between now and 2040 if today's penetration rates hold. So the penetration rate meaning the number of seniors over the ages of 80 years old that move into assisted living or memory care versus those that don't. So that's the penetration rate. And we estimate that there will be a need of approximately 880,000 additional units of senior housing inventory that will needed to serve the senior households ages 80 and over through 2030. So a pretty significant amount of units, around 54,000 units per year between now and 2025, and just under 100,000 units per year needed between 2025 and 2030. And then 2030 and beyond, over 105,000 units per year required just to keep pace with the demand driven by the baby boomers, assuming that we have an 18% penetration rate. So I think long-term, the powerful demographic tailwinds, the age wave, the senior tsunami will correct this overbuilding starting in around 3 to 5 years. This slide really presents the returns generated by other property asset classes over a 10-year period. And seniors housing over that 5 and 10-year period has generated superior returns to all other property types: apartment, hotel, office, and retail. The only property type that has outpaced senior living in terms of investment returns over a 5 and 10-year period is the orange line, which is represented by industrial properties. So seniors housing has been in terms of an investment opportunity, a strong performer over a 5-year and 10-year historical period compared to other property investment types. So although we're in this short-term overbuilding and correction period, senior living has historically generated strong returns as it's been a recession resilient asset. And I believe in the next 3 to 5 years, as we get through the pandemic and we increase occupancies in this space, and then the aging baby boomers start to become the age where they have an impact on occupancies at senior living, that senior living will again be a favorable investment area for investors for many years to come because of the long and significant increase in age of the population 65 and older occurring over a 20-year period. So really moving from here to our closing and what has been our response, McFarlin Group's response to the overbuilding that occurred and now the pandemic. We are focused on acquiring distressed senior living properties with an emphasis on acquiring loans from lenders at deeply discounted prices which really for us creates wide margins of safety for our investors. So we're actually raising money right now for a distressed senior living fund. We have around $10 million raised from friends and family in denominations of 50,000 up to $1 million, but all from accredited investors in IRAs and not in IRAs, but direct investments. And then we're going to continue to raise funds up to around 50 million. And our emphasis is now continuing to work with investors who want to invest through IRA and other means, but also working with single family office, multifamily office, and smaller institutions to get to the $50 million investment offering. So our focus is buying distressed senior living assets with an emphasis on the loan. So essentially loan to own, where we come in, we foreclose on the asset, which lenders are scared or shy to do. So we come in, we foreclose the asset to own it. We increase value over a 3 to 5 year period in terms of occupancy growth, growing revenue per unit, compressing expenses, and adding any capital expenditures or improvements that are needed. If it's an older property and it needs some new carpet and other things in order to compete with some of the newer product, we'll come in and add some of those capital expenditures to make it a class B plus or A minus property, which can compete with the newer properties on the market. And then aggregate the properties into an institutional sale so that we'll combine and sell. We'll be buying properties on a one-off basis and then aggregating them and selling them in portfolios of 3 to 5 properties, which creates a better opportunity for an institutional large buyer to acquire senior living properties, because they generally don't like to acquire one-off properties. The institutions that have billions of dollars prefer to invest $50 to $100 million and buy multiple properties than buy one property for 10 or 15 million. And then our target is to generate these returns for investors over about a 4 to 6 year period and generate an IRR of 20% or better. A couple sample transactions. These are properties that we purchased within the last couple months. We are working to actually get them seeded into the fund. The 2 Chabot Street on the bottom has actually been seeded to the fund. It's a vacant medical office building. So not senior living, but related in terms of being a healthcare asset. It's a vacant medical office building outside of Portland, Maine. We bought the loan from the lender for $400,000. We received a deed in lieu of foreclosure a little over a week ago, and we've executed a purchase and sale agreement to sell it to a new user at 1.6 million. So should that close, it will produce a fairly strong IRR for our investors of actually over 100%, and just at or just under a 2.0 multiple in a very short period of time. The top property, Autumn Leaves in Memorial City, is more of our typical senior living profile of a acquisition that we are currently looking at and would plan to acquire. So we bought the loan from Origin Bank on this property in June. We are working to foreclose currently. We expect that we'll be foreclosed in about 60 days. We purchased the loan for about 3.2 million, and after foreclosure and paying some of the other costs, our basis will be a little bit higher than that. But we did actually execute a purchase contract. We're working to execute a purchase contract with the new buyer right now at a price point considerably more than our initial basis. So these are a profile of some of the properties that we're looking to acquire within the fund. We don't expect to acquire, foreclose, and flip, but we are certainly yield driven, and any time that we can sell an asset, achieve a 20% or better IRR for our investors and not take the risk of lease up over a 3 to 4 year period, we're certainly willing to exit a property investment and sell and create profit for our investors. So with that, Scott, I'm happy to address any additional questions that anyone has in regards to the senior living industry, its current themes, and our reaction or response to what we're seeing in the market.
Sure. Thanks, Matt. Great information today. I'm sure the people who are listening are really getting a lot out of this. Very a lot of data driven. I know it's a lot of our clients and contacts like to see that. We did have a couple questions pop up here towards the kind of when you got to the last few slides. So we'll go through those. And again, anyone listening live, if you have your own questions, please pop those in as well. First question came in, says, do the returns factor in the depreciation expense? And if so, can you benefit if using an IRA money to invest? So I'll let you take part of that, then maybe I can address kind of the second part regarding the IRA.
Yeah, so our returns that we present in our 28% IRR is truly cash in and cash out. So we don't necessarily factor in depreciation, amortization into our returns for investors, because some investors can benefit from depreciation, some investors can't. But our investments, generally because they're focused on distressed investments, will have losses in the early years. So there could be some benefits to investors through taking some of these losses. Scott, I'll let you take that part of the question. But the 28% IRR is a true cash in, cash out, does not take into account any benefits that an investor may get from depreciation, amortization, or any losses that are passed through a K1.
Yeah, and so to jump on that part of it, so for if someone's looking at IRA versus non-IRA, an IRA, generally speaking, doesn't take any deductions and depreciation or losses unless the investment that the IRA is making generates UBTI or UBTIT tax, unrelated business income tax. And that was actually one of the questions that somebody had, and I can ask you that, Matt. Do your investments generate UBTI? And again, before you answer, for those of you people who are unfamiliar with UBIT, the unrelated business income tax, it applies in circumstances when your IRA is invested into leveraged real estate assets. So a lot of if you're using your IRA to make a down payment and get a loan for the balance, UBIT would certainly show up. If your IRA was investing into a real estate deal where the real estate was raising, the syndicators were raising, say, 2 million, and then getting a loan for the balance of the purchase, there's debt there. And so when there's debt involved in the investment, your IRA, if it's invested into that asset, your IRA can be subject to this tax called unrelated business income tax, UBIT. So Matt, getting back to you, do your investments generate UBIT for IRAs? And if so, then obviously you can use the deductions and depreciation to offset that. But I wasn't sure kind of on your investment structure if UBIT does apply.
Yeah, so to add to that, Scott, as we get this question a lot, investments in real property assets who generate income, and they generate income in a variety of ways. The type of income determines what is subject to unrelated business income tax. Rental income, like multifamily properties, is often excluded from UBTI or UBIT. However, service income is the exception. So hospitality and senior living properties generally do trigger UBTI, since our base rent includes service income like meals, transportation services, cable television, internet, etc. So generally, our properties are subject to UBTI or UBIT, but it is calculated based on the amount of leverage a property has and other factors. And so to determine that, in a year for any property, the debt financed ratio is calculated. So we do go through these calculations if an investor needs it, and we generally refer investors back to their own tax or advisory counsel to determine if it does or does not apply to them. But generally, because we produce income from services, our rents are subject to UBTI.
Yep. And so again, following up then on that, the individual's question, if UBIT is going to apply, which it sounds like in many circumstances it certainly may, then in that case, your IRA can use deductions, depreciation, other losses to offset how much UBIT tax the IRA would even have to pay. So again, but that's a question to to take to your CPA probably to really do the analysis to figure out what you'd be looking at from a tax perspective. So another question we had is this investment better in a non-IRA funds considering the tax benefit? Again, I think if you're looking at using the IRA funds or using non-IRA funds to make an investment, definitely looking into the different tax benefits that are there and the impact of UBIT on your IRA is going to be the determining factor. So that's something I think, is it better than non-IRA funds? Probably for some people, and some people it may not be, depending on what they have to invest. Because one thing to always remember with your IRA funds, if you have money in an IRA or an old 401k account, you have to have that money invested somewhere. So even if you're paying UBIT tax in certain circumstances, if the overall return is still pretty good back to your IRA account, you still may look to make that investment inside the IRA. But if you do have money in an IRA, money not in an IRA, you have both baskets there to choose from, then perhaps that's, again, a consideration and a discussion you would have with your CPA as to which is going to make more sense. And I think somebody asked, would the investor receive a K1? I'm assuming all your investors do get a K1, whether it's an IRA or not. Is that correct?
Yes. Yep, and we generally try and produce those by the end of February to give our investors ample time for inclusion into their annual filings.
Okay. And question, I guess, one is, how do you ensure the safety of your senior living facilities? I think kind of especially in the era we're finding ourselves in now. I guess they're asking kind of when you're operating one of those facilities, what do you do from a safety perspective to make sure you're taking care of your residents and everyone else involved?
Yeah, good question. As we're in this business because we enjoy what we do, we enjoy caring for seniors, and they are the most vulnerable population. So caring for and protecting them is our highest priority as a senior living owner and investor. So we have a number of things in place. Number one, and I won't go through them all, but I'm happy to follow up with anyone that is interested in learning more about either our investment or just has further questions. You can reach me via our website, McFarlin-Group.com, and you can submit a request for a meeting there. So generally, we have significant amounts of PPE on site, including full gowns and headwear, so that if any resident does contact COVID, we have appropriate PPE on site. We essentially have engaged a third-party clinical consultant that has helped us build and implement a comprehensive 80-page policy and procedure for combating the current pandemic. And it's broken up into 3 phases, a red phase, an orange phase, and a green phase. And right now, most of our properties are in the orange phase, which means we're limiting group activities to small numbers, which includes social distancing. We are doing dining in our dining room and other areas of the community where we can have social distancing for generally 1 or 2 meals a day, but not all 3 meals a day. And so we have this phased approach that determines what activities we can provide and how residents and staff interact with each other. It's very specific in terms of we don't allow employees that are working in our secured Alzheimer's memory care area, we don't allow them to cross over and work into assisted living. So we try and divide our staff. We do temperature checks and questionnaire on all visitors, which includes essential medical professional and our employees every shift before they arrive. Everyone has to egress in and out of our buildings through 1 door as opposed to multiple doors. All staff are required to wash hands upon arrival, wear masks and protective gear. We're trying to limit the number of staff members providing direct care to residents, so we're trying to minimize that. I'd say that the most vulnerable area of the senior living business is the Alzheimer's or memory care area, as those residents, because of their cognitive impairment and disease, are not able to understand the current challenges and pandemic, and therefore they're not an active participant in managing their health and safety, meaning that it's difficult to keep a mask on a memory care resident. It's difficult to quarantine them in their apartment. And so they are the most vulnerable within our senior living communities, which is why we work real hard to create an environment where we're limiting the number of people coming in and out of our memory care areas, because the virus won't affect a senior living resident that is living in our community because they're not leaving the community. Generally, we're bringing in healthcare professionals. So they would contract it from someone that is coming from the outside, either a caregiver or an employee or a healthcare professional coming in. So some of the advanced things that we are trying to do, because a lot of essential medical professionals may visit seniors at multiple communities. We track via geofencing any senior living community that we know has active COVID. We can track whether that person generally are also visiting our senior living community. So now we don't allow people into our community that may be providing similar services at other senior living communities that we know have COVID-19. In addition, we're not letting or allowing any of our employees to work at any other senior living facilities during this time period. They're only allowed to work at our facilities, which means that they're not going into another community, potentially picking up COVID and bringing it back to our community. So that's just kind of scratching the surface of some of the things that we do to protect residents. We have a pretty detailed plan and policy and procedure in place, and then it just comes down to detailed execution at the property level.
All right, thanks for the answer, Matt. And we have a couple of questions. I know we're a little bit past, so have enough time for another question or two. Again, if I didn't get to your question, the contact information for Matt and the McFarlin Group is right on the screen here to reach out to them to get the question answered. One question: do you need a K1 if the investment is in the IRA? The answer is yes. You would get a K1 back to the IRA if your IRA has made that investment. Question was, let me get back to it here really quick, Matt. Someone said, are you turning condos or apartments into ALFs, or are you buying only existing facilities? Are you doing any kind of conversions in that regard?
Yeah, we're looking at some conversions of hospitality, but it's very difficult, we found, to convert a hotel into senior living, as senior living code is determined by state, and most states require that if you're going to build multi-story, so 2 or more stories, they require non-combustible construction, so metal stud rather than wood stud. So a lot of the 4-story La Quinta, Hampton Inns, Marriott that you see that are 4-story are built out of wood construction rather than metal stud or steel, and therefore you can't convert them into certified assisted living or memory care. In addition, a lot of times they have smaller studio units and they're not ADA accessible or compliant. So we have not done a conversion. We have looked at it, but we just haven't found the right opportunity. We are really focused on buying existing senior living properties that were purpose built and just buying them at considerable discounts to cost or considerable discounts to their loan value, and then increasing occupancies and then ultimately aggregating and selling.
All right, and Matt, two more questions. One said, are you also operating skilled nursing facilities in addition to memory care units? And then the last question is, do you have a minimum investment requirement? So I'll let you handle those 2 questions, and we'll close it up for the day.
Great. We do not operate any skilled nursing. We did buy in 2019 the loan. We bought a $8.9 million loan on a vacant skilled nursing facility. We did buy that. We foreclosed, actually got a deed in lieu of foreclosure in Connecticut, and then we sold that loan. But we do not generally tend to operate skilled nursing facilities unless they are part of a broader continuum of care that also offers independent living, assisted living, and Alzheimer's all on one campus. In terms of investment, we do accept lower minimums, especially for first-time investors that want to get to know us, understand our reporting requirements, and want to make a smaller investment initially, and then potentially increase that investment in the future as they become more familiar and more comfortable with the McFarlin Group. So we certainly are flexible in that. Our full offering memorandum is available for download on our website at mcfarlin-group.com. And my phone number is here. My email address is matt@mcfarlin-group.com. And so investors can certainly reach out to me via phone, via email, or you could download the investment perspective right off our website. And then we can facilitate potential investment from anyone at that point.
All right, Matt, thanks. So, and then just to follow up on that, do you also, as an individual, your investors have to be accredited as well?
So our investors generally do have to be accredited. We have a verification process that we have a third party go through, or we have a CPA, our chief financial officer is a CPA, so they can also provide that certification for investors. However, the IRS just released rules on being an accredited investor. There is now more flexibility. So the test for an investor being accredited was historically asset and income based. I think it was 200,000 or 250,000 in annual income, and then over $1 million in net worth. It's now been changed a little bit, and so there is a little bit more flexibility for investors. There are other tests beyond just monetary tests for an accredited investor. So all that to say, we can offer our investments to a broader audience because of the loosening of the requirements under the accredited investor definition by the IRS.
Yeah, I saw those rules had come out. That'll be interesting to see how that changes the industry a little bit as those rules get more flushed out and people understand exactly how they apply to their situation. So, Matt, again, thank you very much for coming on today. Some great information shared. Again, probably love to have you back at some point, maybe in another 6 months or so, and see, obviously how the pandemic is influencing your industry now, and if we're definitely seeing those upward trends that you're expecting. Again, anyone who is interested, you can join us on September 25th, and then every other Friday after that as well for our Pitch, Promote, and Prosper event, for your opportunity to, again, share what you're looking to invest in, or share your investment, and a chance to really share, connect with people who have that same mentality or looking for fellow investors, and providing that online meeting place to do so. So hopefully you register for those events. Here's my contact information on this last slide. Matt, if you want, maybe give out your phone number and email address one more time for anyone who would need it.
Great. My phone number is 469-619-5418. And my email address is Matt, M-A-T-T, at McFarlin, M-C-F-A-R-L-I-N, dash like a hyphen, group.com.
All right, Matt. Yeah, Matt, thank you very much. We had a lot of in addition to the questions, we had a lot of comments too on just a great presentation, very informative, which I obviously felt that way as well. So really appreciate it. Hopefully have you back soon.
Great. Thank you, Scott. Appreciate it.
All right, thanks, Matt. Thank you everyone for listening.